Hello everyone. In today's video, I want to discuss with you about the recently announced merger between Teladoc and Livango Health. We will go over the profile of both these companies, the specifics of the merger deal, the market's reaction after the deal was announced, and then I will provide my thoughts on whether I plan to buy either of these stocks at the current levels. So let's first talk about Teladoc. In short, Teladoc is a virtual healthcare mediator who connect patients virtually with healthcare providers through their electronic portal. It is a leader in this industry, and in recent times, their popularity has grown immensely as the world is embracing digital services more and more. As you can see, they support a peak volume of over 200,000 interactions, and due to their virtual nature, they are essentially open round the clock, giving the patients and care providers a high degree of flexibility and convenience. In terms of their revenues, the company has grown significantly since they went public in 2015. As you can see, the revenues have grown from $77 million to a staggering estimated $987 million for 2020. The company is still not profitable though, as you can see from their earnings per share chart. But this is quite common for young growth companies these days, as the focus is in getting maximum market share instead of rushing to make a profit. It is notable though that the company is trending in the right direction as their cash from operations has turned positive since 2019 and is expected to grow at a nice clip for 2020 as well. It can also be seen in this chart that their member base has grown consistently year over year. Moving on to Livango, they are in the virtual healthcare space as well, but their customer base is people with chronic illnesses like diabetes, to whom they offer data-driven products and services that they believe would deliver better clinical and financial outcomes. With their products and services, they help customers to manage chronic illnesses by providing timely health alerts on their proprietary platform. As you can see from this snippet from their investor presentation, they use data-driven technologies to decode applied health signals, thereby empowering their customers with chronic health conditions to live healthier lives. Compared to Teladoc, Livango only IPO'd in July 2019, and again as you can see in this chart, the revenue growth has been exponential. Cash flows and EPS don't seem to be the focus at this point compared to gaining market share, and as you can see, their user base is growing at a 100% plus rate year over year. Now let's talk about the merger that was announced on the 5th of August 2020. Before starting off, to me this looks more like an acquisition of Livango by Teladoc rather than a merger. I feel the term merger is being used more as a positive spin. Anyway, the transaction is expected to be executed by valuing Livango around $18.5 billion, and when the deal is closed, Livango shareholders will get 0.592 shares of Teladoc plus $11.33 in cash for each Livango share. And I believe the new merged entity will be called Teladoc Health and continue to be traded under the ticker symbol TDOC. The merger is expected to be closed at the end of 2020, subject to approvals. In terms of the benefits both companies believe will be achieved via this merger, it is anticipated that this combination will help broaden the market share and accelerate the vision of creating a single virtual platform to provide holistic healthcare solutions, as well as expand revenues by an additional $500 million by 2025 from cross-selling activities. And as you can see here, both companies are in the virtual healthcare solutions industry, but their specific service models are differentiated, which is expected to enhance the capabilities of the combined company. Now let's look at how the market reacted to this news. As you can see in these charts, the news was not well received by the market and both stocks sold off substantially. Teladoc was down 24% from its peak of around $250 to around $193 at close of trading on August 7th, whereas Livango dropped 19% from around $150 to $121. So overall, the market seems to not like the merger announcement. From what I see, it looks like Teladoc shareholders feel that the price proposed to acquire Livango is very high, whereas Livango shareholders may feel it is too low. In addition, it is surprising to see that Livango even wants to go ahead with this deal, as it is a very young company, and typically if the founders believe in the business model, they wouldn't want to merge with a larger player so early in their business cycle. So what does this all mean to us? Personally, I'm not super excited by this merger news, but think this industry has a lot of growth potential. It is likely that the growth may reduce a bit if the global health situation stabilizes, but irrespective of that, in the long term, I see a lot of potential for growth in the virtual healthcare space, and Teladoc would be a front runner to benefit from this. I also feel it may become an acquisition candidate in the future for larger companies like Google, Apple, or Amazon when they eventually get into this industry. So I had been looking for a good entry point to buy Teladoc and might use this opportunity to buy some shares. Overall, I think this is still a speculative investment, at least in the short term, so I will not invest more than 2% of my overall portfolio. And I do feel that both Teladoc and Livango may continue to drop a bit more in the short term, so I will likely buy 25% at the current price and wait for cheaper prices to average into the stock. I could have also considered buying Livango, as eventually, after the merger, these shares will get converted into Teladoc shares, but I like to keep things simple and buy the larger company that has a longer proven track record at this point. And depending on your situation, as I explained in my previous video on ADP, if you are interested in either of these stocks, you can also consider selling put options 10 or 20% below the current market price to take advantage of the short-term volatility which increases the option premiums. This way, you can also get a better entry price if the stock dips in the short term. But please remember that sufficient capital should be set aside to sell put options to cover for the eventuality in case the stock continues to drop significantly below the put strike price. And as a friendly disclaimer, please note that I am not a licensed investment advisor, and my videos are only meant to document my views on various investment related topics that I am interested in. So please consult with your own investment advisor before making any investment decisions. Hope you enjoyed this video, and I would really appreciate if you can please leave a like and comment below and subscribe to my channel. Have a great day, and I'll see you in the next video.